AI boom, a term that dominates the markets. But behind it all is a company without no AI infrastructure would move forward even an inch. That company is Micron. But why this seemingly insuspicious company? The answer is very simple. It's all about memory. RAM, HBM, and entire memory chains are currently experiencing something the market has never seen before. A combination of extreme demand, limited capacity, and dramatic price increases. So, with the current environment favoring memory manufacturers, and Micron being one of the largest in the world, is it realistic for this company, after incredible growth in recent months, to aim for a further 50% appreciation from today's values? To answer this question, we need to understand not only the company's business itself, but also today's memory market. Let's get started. Before we get to Micron, it's important to explain why the RAM market is so tight in 2026. In short, AI. In reality, however, it's a combination of several factors, such as manufacturers' capacity shifting towards the most profitable products, mainly HBM memory and server modules. As a result, the production of conventional memory used in computers and consumer electronics is being reduced, leading to a shortage of products and consequently an increase in their prices. At the beginning of February, Taiwanese company TrendForce significantly raised its memory price outlook for the first quarter of 2026, and the numbers are extreme. For classic DRAM memory, it's no longer a matter of growth of a few tenths of percent, but a prediction of roughly plus 90 to 95% from quarter to quarter. Server memory is then expected to grow by approximately 90%, which would be the largest quarterly increase since measurement began. The scenario is similar for NAND memory and storage. Prices are expected to rise by approximately 55 to 60%, and SSDs are expected to rise by approximately 53 to 58%. Why are prices rising at such an extreme rate? Because AI servers and accelerators need memory like never before. AI and data centers are exacerbating the imbalance between supply and demand, which increases the pricing power of suppliers, and one of the biggest is Micron. But if you're more interested in the competition, you can easily find out more about it on Bulios, where Stockbot will give you a high-quality analytics summary in seconds. The company reported revenue of $13.64 billion for the first fiscal year quarter of 2026, a significant jump from the previous quarter and year over year. The gross margins for the entire company was 56%, and management also set an exceptionally strong outlook for the next quarter. Revenues of $18.7 billion, plus or minus $400 million, and a gross margin of around 67%. The results clearly show that cloud and data centers are clearly driving the main business. The cloud memory segment had revenue of $5.28 billion and very high margins. The company is really doing well, and this is also evident in the chart. Micron's shares have risen by 550% since April last year, which corresponds to an increase of almost $350 per share. However, thanks to incredibly high demand and interest in AI, it seems that the growth is far from over. Today, one Micron share is trading at around $410. However, investment firm TD Cowen recently raised its rating on Micron shares to $600 per share. That's about a 45% increase from today's prices. If Micron really delivers on its guidance of record sales and margins in 2026, earnings per share could remain high even with capex investments. However, Micron would have to achieve approximately $12 in earnings per share, which is an increase of about $1 from the current value, which is not that much, but the PE ratio would have to increase from today's 40 to 50 points in that case. Incidentally, Nvidia's current forward PE ratio is 22. Oh, and all this data, including whether Micron is already fairly priced, could be found on Bulios. So what might happen in the coming months? Memory companies typically do not pay extreme PE ratios at the peak of the cycle because the market knows that the cycle will eventually break. A more realistic path is a combination of high EPS plus a slightly higher multiple if the market believes that part of the demand is structural. At the same time, however, there is a fundamental risk, namely the cyclical nature of the semiconductor industry. When supply catches up with demand, prices fall rapidly, margins decline dramatically, and stocks can fall before this is reflected in the results. The second risk is in the field of competition. For example, SK Hynix is planning a major investment in new factories, including memory chips, in South Korea by 2030, which suggests that competitors are preparing for a so-called super cycle. This means that it lasts longer than a classic cycle. However, if the technology segment and such extended investments are not right for you, you can also find inspiration on Bullios for the other, dividend-paying and stable side of the market. In this article, where our team looked at the top 4 ETFs with dividends of up to 5%, you will learn which segments are benefiting from the decline in software stocks this year and have been posting interesting gains since the beginning of the year.